Hello, my name is Troy Atkins, and I am the founder and owner of Atkins Capital Management. I want to talk to you today about the key policy events that have transpired in the residential housing market for the quarter, to provide an assessment of the mortgage lending environment, and to provide an overview of the home price level for a select group of cities throughout the U.S. The purpose of this quarterly presentation is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. This presentation was produced by Troy Atkins. I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. As a result, we provide objective information and useful analytical tools that help prospective homebuyers make a prudent home purchase decision. For more information about my background, skills, and experience, please review the introduction section on the Atkins Capital Management website. Let me now turn your attention to the primary events that have transpired in the residential housing environment. For the second quarter of 2016, the British vote to exit the European Union was the primary topic of discussion. The British exit vote that took place on June 23, 2016, is perhaps the most dramatic event to date in a wave of populist and nationalist uprisings occurring on both sides of the Atlantic Ocean. The Brexit vote is expected to have a dramatic impact on the U.S. residential mortgage market. International and domestic investors alike drive mortgage interest rates through the mortgage-backed security market. Because these securities are considered relatively stable, they attract buyers when economies and markets elsewhere flounder. The Brexit vote is expected to attract more mortgage lending capital from abroad, thus reducing the cost of debt for mortgage lending borrowers in the U.S. Mortgage rates are also heavily influenced by the yield on 10-year Treasury notes, and investors have flocked to them to escape the turbulence in foreign markets. This in turn is expected to lower the cost of debt for mortgage lending borrowers in the U.S. During the past month, 30-year fixed-rate mortgages have hovered around 3.7%, nearly a 3-year low. The Brexit vote is expected to drive rates even lower. The long-term impact on the mortgage lending market will likely be to keep mortgage rates at low levels. This in turn will likely lead to another pickup in refinance activity. For the second quarter of 2016, the release of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University provided a wealth of information pertaining to the residential housing environment. Here is a summary of their findings. For 2015, sales of existing homes approached 5.3 million units. In comparison, sales of new single-family homes were 501,000 units. For 2015, the median price for existing homes was $222,400. In comparison, the median price for new homes was $296,400. During this time, real median income of U.S. households was $53,700. Using the Atkins Residential Home Valuation Analyzer, and assuming that 28% is the largest amount of household income that should be spent to repay the cost of a mortgage loan, the justified mortgage loan interest rate for the U.S. as a whole would be 5.45% for existing homes, or 3% for new homes. Using the Atkins Residential Home Valuation Analyzer, and given the quarter-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, the justified percentage of household income amount would be 23% for existing homes, or 30% for new homes. At 1.1 million units, new home construction was still running near historic lows. As a range of comparison, new home construction exceeded 1.75 million units in 2005, but was less than 500,000 units in 2008. In comparison, household growth is projected to exceed 1.3 million units per year over the next decade. More results from the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University are as follows. The uptick in nominal home prices helped to reduce the number of homeowners underwater on their mortgage loan from 12.1 million at the end of 2011 to 4.3 million at the end of 2015. The U.S. homeownership rate has tumbled to its lowest level in nearly half a century. CoreLogic estimates that more than 9.4 million homes were forfeited through foreclosures, short sales, and deeds in lieu of foreclosure from the start of the housing crash in 2007 through 2015. Foreclosure rates are still at levels twice the annual average before the housing downturn. Single-family homes are getting bigger, with the median size a record-setting 2,467 square feet. Only about a fifth of the homes built in 2015 were under 1,800 square feet. According to the JCHS, homeownership is expected to face more headwinds due to the backlog of homes in foreclosure, tight credit, weak income growth, and impaired credit histories. Moving away from the issues surrounding the Brexit and the results of the study from the JCHS, for the second quarter of 2016, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan began the quarter at 3.81% and ended the quarter at 3.54%. Since June of 2011, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan has been less than 4.61%. In order to better assess the current mortgage loan interest rate environment, prospective homebuyers should remember that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan reached an all-time low of 3.31% in November of 2012, and it reached an all-time high of 18.63% in October of 1981. Prospective homebuyers should closely follow the level of mortgage loan interest rates in their community, because a rising cost of debt will increase the amount of interest expense that homebuyers will have to pay for their mortgage loan. This in turn will place downward pressure on the price level of residential housing in their community. Now that I have provided an overview of the events that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary financial methodology and cloud-based analytical tool that can be used to provide an assessment of the price level of homes in a community. The Atkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Atkins Residential Home Valuation Analyzer can accurately assess the price level of homes in a city. From the first analytical perspective, the Atkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in a city by calculating the mortgage loan interest rate that justifies the price level of homes in the city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in a city. From the second analytical perspective, the Atkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in a city in order to justify the price level of homes in the city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in the city. By utilizing the Atkins Residential Home Valuation Analyzer, prospective home buyers can determine the level of underpricing or overpricing of homes in a community in order to assist them in making a prudent home purchase decision. For more information about our finance-based analytical methodology and the Atkins Residential Home Valuation Analyzer, please watch our Review of Residential Real Estate Analysis Valuation Methodologies movie presentation and our Residential Real Estate Analysis Software Application movie presentation. Both of these presentations can be found on the Atkins Capital Management website. Now that I have provided an overview of how the Atkins Residential Home Valuation Analyzer is utilized, let me provide an overview of the home price level for a select group of cities across the U.S. For the second quarter of 2016, 23 cities that make up the Atkins 60 City Home Price Index were classified as overpriced for the quarter. The top 5 overpriced cities were Bridgeport, Honolulu, New York City, San Francisco, and Los Angeles. In terms of a relative price level analysis, it is important to note that it is not possible to justify the home price level for the top 5 overpriced cities by reducing the mortgage loan interest rate from 3.54% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective home buyers to spend more than the justified percentage of household income amount. As an alternative, in order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $81,583 and $144,150. Finally, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $182,700 and $360,938. Prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to accurately assess the level of overpricing or underpricing of homes in their community. On the other side of the spectrum, 37 cities that make up the Atkins 60 City Home Price Index were classified as underpriced for the second quarter of this year. Detroit, Wichita, Sioux Falls, Little Rock, and Wilmington were identified as the 5 most underpriced cities in the index. While Sioux Falls has the same justified percentage of household income amount as Little Rock, Sioux Falls is ranked as the 3rd most underpriced city in the index due to its higher justified mortgage loan interest rate amount. Moreover, while Wilmington has the same justified percentage of household income amount as Omaha, Wilmington is ranked as the 5th most underpriced city in the index due to its higher justified mortgage loan interest rate amount. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 3.54% to more than the justified mortgage loan interest rate for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the justified percentage of household income amount in order to repay the cost of a mortgage loan. Given the events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Atkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, and to subscribe to use the Atkins Residential Home Valuation Analyzer, please visit the Atkins Capital Management website at residentialrealestateanalysis.com. Thank you for taking the time to listen to this presentation.